free cash flow valuation. And I can safely say that this is perhaps one of the most important readings in the course. So almost guaranteed question. And the reason is obvious. Financial analysts will invariably do some cash flow based analysis. And obviously to do cash flow based analysis, you need to come up with your cash flows and then value based on cash flows. So extremely important reading, both from a perspective of the exam and from the perspective of a real life analyst. Okay, so what will we do in this reading? The basic idea is to understand the concept of free cash flow to firm and free cash flow to equity. What are the relevant valuation approaches? How do we forecast free cash flows? And what are some variations on free cash flow models? And then a quick excerpt on the concept of non-operating assets and firm value. Okay, some introductory remarks, and to an extent we've seen this already both in level 1 and in our reading on dividends. But here is a popular question, which basically is around when do you use the free cash flow method? Okay, so analysts like to use free cash flows as the return when one or more of the following conditions is met. So it's one or more. And here we are talking generically about both free cash flow to firm and free cash flow to equity. We'll draw a distinction in a short while. If a company does not pay dividends, then obviously it's hard to use the dividend discount model. You use this. The company pays dividends, but the dividends paid differ significantly from the company's capacity to pay dividends. Okay, we saw this earlier with the Coke example. All right, so the amount of dividends they paid was much less than their capacity to pay, and hence dividend discount model was not an appropriate model to use, but free cash flow would be. Free cash flows align with profitability with a reasonable forecast period with which the analyst is comfortable. And finally, investor takes a control perspective. So you've seen this before, but I am doing it again because it is extremely important. Okay, Okay, so the question is around the concept of control perspective. The idea, let me just make a real simple example. Let's say that you like FFC, a stock that's traded here, and you want to buy 1,000 shares. All right. The reason you buy FFC is because it gives a good dividend. The dividends, let's say, are generally aligned with the earnings. So when the earnings go up, the dividends go up. Okay. By buying 1,000 shares, do you think you can change the dividend policy? Do you think you can change the capital structure? And you probably can't make any fundamental changes to this company that make it more or less efficient. So do you have control? No. So as far as you are concerned, for every piece of paper that says 4G fertilizer stock on it, you are getting the dividend. And hence the best way for you to value that particular stock is to look at the present value of the dividends that you will get. Okay. Now let's say we talk about another small company called Fatima Fertilizer, and you are a large industrialist who is planning to take over this company. Now this company also pays a dividend, but your plan is to take this over, and you believe that this company has a tremendous opportunity to expand. So you believe that the current dividends don't reflect the potential earning opportunity in the future. So you plan to take this over, take control, and make the company more efficient and increase the cash flows. You plan to initially reduce the dividends because you want to reinvest, and ultimately you want to maybe make this company much larger and sell it, or something to that effect. In the latter category or latter scenario, it does not make sense to really use the dividend discount model because you do not believe the dividends reflect what the company can do in the future. So in this particular scenario, what you will do is you will model the free cash flows, and to figure out the value of this company to you, you will actually do the free cash flow valuation and free cash flow estimates based on what you think you can do with the company. Okay, so in that scenario, would you use the present value of dividends, or given that you are taking a control perspective, you are going to look at the present value of the free cash flow? You look at the present value of the free cash flow, and that's what control perspective means. Okay. Now let's define the two kinds of free cash flows. And I'm sure you at least recall seeing this in level 1, but now you need to make sure you get a good, thorough understanding of this. So free cash flow to firm is the cash flow available to the company's suppliers of capital after all operating expenses, including taxes, have been paid and necessary investments in working capital and fixed capital have been made. So the points to highlight: suppliers of capital would be both the debt holders as well as the equity holders. So this is the money available to all of them. And after you have made your investments in working capital and fixed capital. So assuming that the company is on a track where it is going to make, so keep growing. All right. Free cash flow to equity is the cash flow only to equity holders. So cash flow available to the company's common equity holders. Notice it's common equity holders, not both common and preferred shares. So just the equity holders. After all operating expenses have been paid, interest has been paid to the debt holders, principal payments have been paid, and all necessary investments have been made. So core definitions that you should know. Okay. Now, for the first time, we will look at the distinction between free cash flow to firm and free cash flow to equity and figure out what to use where. Okay, so a levered company with negative free cash flow to equity. Okay, what method do you think you'll use here, Mobeen? So, if you have a levered company where FCFE is negative, so levered company means a lot of debt. So after you are paying off your debt holders, the money left for equity holders, at least for the next couple of years, is negative. Do you think it's possible? Do you think it's sensible to use free cash flow to equity and discount that, or does it make more sense to use free cash flow to firm? So yeah, so you should use free cash flow to firm if you have this situation. But is it possible to start with free cash flow to firm? Let's say you figure this is 120 million. From this, then, how will you figure out is it possible to figure out the free cash flow to equity? Yeah, you simply deduct the debt. There is also this concept of cash and marketable securities. For simplicity, we'll assume that this is very small and negligible now. And towards the end of this reading, we'll come back and discuss exactly how to deal with it. But for now, to come up with free cash flow to equity, you simply take the free cash flow to firm and subtract the market value of debt. Assuming marketable securities are negligible, then that will give you your free cash flow to equity. Okay. So firm value, what do we mean by firm value here? This is the present value of all the free cash flow to firm. So whenever we say firm, this is the overall value which includes the present, which is basically the present value of free cash flow to firm. So that's what I've written up there. Minus the market value of debt will give you the value of equity. Actually, what I should write here more accurately, it's the present value of all the free cash flow to equity is equal to the present value of all the free cash flow to firm minus the market value of debt. Okay, another scenario where free cash flow to firm is preferred is with a levered company with changing capital structure. Okay, so if you are coming up with the value of a company where the capital structure has been changing a lot in the past, or you expect the capital structure to be fairly fluid, so changing often in the future. So in those circumstances, it is also preferable to use the free cash flow to firm approach. Okay, so this is just clarified here. On historic basis, free cash flow to firm growth may be more representative of fundamentals than free cash flow to equity growth. So here, better to use free cash flow to firm. On a forward-looking basis, given changing capital structure, the required return on equity may be more sensitive to changes in capital structure than the changes in WACC. So the point here is that obviously if the capital structure keeps changing, does that change the cost of equity? Yeah, if the capital structure keeps changing, company is more risky, then maybe this will go up. Does the WACC change? It might, but the impact on WACC will be less. So if you have the capital structure changing, the WACC generally tends to be more stable than cost of equity. So we can talk about this separately, but WACC is sort of a weighted average. And when a company, and we discussed this in corporate finance, when a company becomes more risky, so RE goes up, but then RD is generally lower and the weightage of RD goes up. So obviously it changes, but doesn't change as much as cost of equity. So in both these circumstances, use free cash flow to firm. Not a huge concept. I just think that it's one possible thing you can be tested on, so you should know where to use what. Okay, this reading actually is fairly straightforward. There are a few subtle things that I'm going to point out along the way. Other than that, it's basically modeling your free cash flows and discounting them back. Okay, so let's just, the firm value, for example, I hope this formula is extremely familiar to you. All we are saying is the firm value is simply the present value of all future free cash flows discounted at WACC. Assuming constant growth, this can be a little tedious. So if you assume that the free cash flow is growing at a constant rate, then what does this formula become? So then the present value is simply free cash flow to firm at period 1 divided by WACC minus the growth rate. Okay, so that's the firm value assuming constant growth. So that's simply the Gordon growth model applied to free cash flows. And then I'm sure you remember this, how do you calculate WACC? It is it's your relative market weight of debt, assuming only debt and equity, so that's market value of debt as a fraction of the total value, times RD multiplied by 1 minus the tax rate plus the market value of equity over total value of debt and equity times the cost of equity. So this is a quick refresher on WACC, which I'm sure you remember. Okay, and then from the firm value, as we discussed, if you want to calculate the equity value, that's simply the firm value minus the market value of debt. Okay, now let's do the free cash flow to equity calculation another way. You can also calculate equity value by taking the present value of all the free cash flow to equities and discounting at the cost of equity, and assuming constant growth, what will we do? So then it is simply free cash flow to equity for year 1 divided by what is this R? Yeah, that's the cost of equity. So this is fairly straightforward. Okay, now if it is that straightforward, let's see you do this. If you have the curriculum open in front of you, I want you to try to do it without looking at the solution, and then we can discuss the solution. Okay, so I hope this is obvious to everyone. The WACC is simply the weighted average with the data given. The firm value is equal to the free cash flow to firm at period 1 over R minus G. So simply applying the Gordon growth model, you get 14,134.6. That's the firm value. Then you come up with the equity value by subtracting the market value of debt. So that's your equity value, and then you get your share price by dividing this with the number of shares outstanding. So nothing too difficult about this. That's why I say in this equity segment is 20 to 30% of the exam. The highest weight, the easiest. So nobody, I think, can pass this exam without doing well in this. Your target should be at least 80% in this topic. Okay, now computing the free cash flow to firm from net income. You saw this in the cash flow statement in level 1, and at that point you might have just memorized it. Now you really need to use this well. So the free cash flow to firm in a given year, to compute it from net income, you start with the net income which is available to common shareholders. So here is a small trick question. If you are given the net income at the end of the income statement of 100 and the preferred dividend is equal to 10, then what number do you use here? You use 90. So it is, because if that's net income and separately you have to make a preferred dividend of 10, then the amount available to common shareholders is actually 100 minus 10, which is 90. So be careful about that. Then you add non-cash charges such as depreciation, because we are doing a free cash flow. You add back interest expense. Why is that? Yeah, so this is now for the firm, which includes the bondholders. So you also want to see what money is available to them. This after-tax interest expense had been subtracted to come up with net income. Now you add it back. Why? Because net income is from the perspective of shareholders. Now we need to take the perspective of both shareholders and bondholders. So we add this back. Less investment in fixed capital. Now in level 1 we had just said, okay, investment in fixed capital. Now we are going to go into the subtleties of exactly how to calculate this. And it is not as simple as simply doing net working capital at the end minus working capital at the beginning. There are some issues that you need to know. And then we subtract any investment so subtract the investment in fixed capital, subtract the investment in working capital. Why do we subtract these when coming up with a free cash flow? The reason is our assumption is that the necessary investments still need to be made. So the assumption is this company is going to grow at the pace that it's expected to grow at, and hence it needs to make the necessary investments in fixed capital and working capital. The question is, why are we adding interest expense back? Because we are taking the perspective of a firm which includes both debt holders and equity holders. In net income, do you subtract interest? You subtract interest because you are taking the perspective of shareholders. Now, if we are saying, okay, what's the money available to pay out to both shareholders and bondholders? Bondholders get the interest amount is available for distribution to bondholders, so you add it back. So that's why we add it back. The dividend was never subtracted in the first place. So dividends have not been... Okay, I'm sorry. Yeah, okay. So that's actually, I need to make a small correction here. So the question is, what about the preferred dividend? So if we are talking about free cash flow to firm, then you can ignore what I said earlier, where if this 100 does not include the money that has been paid out to preferred dividend, then you just start with 100. If we start with 90, then we should add back the 10 for preferred dividend. So essentially it is all the money that is available to all suppliers of capital. Thank you. Good point. Okay, so as a formula, this can be written like this. Free cash flow to firm is equal to net income plus non-cash charges. So basically this formula should look very familiar, and I can guarantee that there will be some use of this formula on the exam. Okay, let's see if you just memorized that formula. And for let's say for 2010, given this data, I want you to start with the net income and have you come up with free cash flow to firm. This might seem trivial, but I'm building up towards making you practice something that you will get on the exam, and there are some subtleties that we need to be careful about. So I want you to do this for 2010. The answer is actually 117. So in a minute nobody has gotten the right answer yet. So I'm just going to show you how to get that. And that's why it seems trivial, but you have to practice this. Okay, let me help you through this. Okay, so what are we doing here? We are starting with net income. And then we will work our way down. So what's the net income? So net income is 118. Okay, then when you work your way from net income towards the free cash flow to firm, what is the first thing that you do? You add back non-cash charges. So what are you adding? What's the non-cash charge here in this simple world? So you have your depreciation. So you add that 50, 54. I'll just work with whole numbers here. So you add back 54. Then what do you add? Then you add the after-tax interest. So where is the interest? So the interest is, it is 18, but you do it on a after-tax basis. So when you do interest on an after-tax basis, so nobody asked for actually you are given the tax rate. So 18 into 0.7, which is 13. So that's the adding back of interest. Then what do you do next? You subtract your working capital investment and your fixed capital. Okay, now what is your working capital? It's your net working capital. Do you in your working capital, do you consider cash? No, because you are calculating the change in cash. So your working capital we are doing the change in working capital. That's your working capital investment. What's your working capital at the end of 2010? Your net working capital. It would be these two guys, the receivables plus inventory, minus the accounts payable. If we had a current portion of long-term debt, would we count that? No. In your working capital, you only consider things like accounts payable and essentially your non-interest bearing debt. So accounts payable, accruals, stuff like that is working capital. The current portion of long-term debt or a short-term note payable, those are all considered financing. They are not considered working capital. They are not considered operating stuff. So so you do this for 2010. What's your net working capital? It would be 121 plus 79 minus 60. This is for 31st December 2010. And then you do the same for 31st December 2009. Okay. So then you take the 2010 net working capital, subtract out the 2009 net working capital, and the amount that you should have gotten is 13. Okay, so you subtract 13 as your investment in net working capital. Okay, then what's left? Your investment in fixed capital, okay, basically your long-term assets, or here your fixed assets. Okay, do you remember one of your favorite topics from level 1 where you had to figure out how much cash is spent on investments? So when you were doing the cash flow statement, you were figuring out how much money is spent on, say, machinery. The way you figured that out, since I've not told you anything else, the simplest assumption to do is look at the increase in gross fixed assets. That's the simplest thing to do. Obviously, depending on what else is sold, this might change, but I'm not telling you about anything being sold. So if your fixed assets went up from 550 to 605, what do you think your investment in fixed assets was? 55. So you subtract the 55 and you should get 118. Okay, so effectively the same as your net income. Okay. Look, we are talking cash flow. So the question is, what about accumulated depreciation and so on? So here is a simple idea. If the gross amount of your assets at the start of the year was 100, or let's take these numbers. Gross amount of your assets at the start of the year, where did that number go? Is 550. And at the end of the year, the gross assets is 605. Then simplistically put, how much money did you actually spend? Depreciation is non-cash, right? And we are just talking cash. Okay, we can discuss that later. For now, the method over here is to look at the difference between the gross amounts. Okay, if you want to, we can discuss it the minor points later. Okay, so anyway, this is a extremely important calculation that we should be able to do. Okay, is everybody fine with this? So actually you should know this. All right. So, okay, now the next subtle point. What have we done so far? We have calculated free cash flow from net income. How can you calculate the free cash flow from the statement of cash flows? It seems plausible that some work has already been done in coming up with the cash flow statement. If you are starting with that cash flow statement, it might be a little bit easier to figure out your free cash flow to firm when you have your cash flow statement in front of you. But do you remember this distinction between IFRS and US GAAP? Where let's talk about things like interest received, interest paid, etc. US GAAP is nice and simple, where all these items are classified as operating, but IFRS gives options. So if you are looking at an IFRS cash flow statement, then what's the first thing you need to determine? So all the interest amounts, let's say the company has issued a bond, so the interest payment is being made to bondholders. The question is whether that interest payment is being classified as operating or investing. Why is that important? Because in this segment, you are starting from the CFO and the cash flow from operations, and you are figuring out your free cash flow to firm with the CFO as a starting point. You clearly need to know what's contained in your CFO, which is your starting point. So if, for example, we subtracted the interest paid and then came up with CFO, then we need to add back the interest expense. Okay, and then we subtract the investment in fixed capital. So that's all. In the earlier slide on free cash flow to firm from net income, just to make sure you are clear on this, what was the formula there? That was equal to net income plus non-cash charges plus the interest into 1 minus T minus the working capital investment minus the fixed capital investment. Now, in this statement where we are starting from CFO, why are we not, where did the NCC go? That's already, so in fact, what you know is that CFO, simplistically, is equal to the net income plus non-cash charges and minus the, so the CFO already has these things factored in. So if instead of this area that I have sort of shown, we remove that stuff and put in CFO, then effectively we are left with this formula. If I tell you that the interest, according to this company, interest paid is considered financing, then what would you do? How would this formula change? The company categorizes interest paid to bondholders as a financing activity. Will this formula change? Yes. How will it change? Yeah, actually then the formula simply becomes CFO minus fixed capital investment if we are assuming that if we are assuming that the interest is classified as financing. So fairly straightforward, I hope. Okay, so then let's do it. So let's calculate the free cash flow to firm starting with CFO. Yeah, again 2010. Assume this is a US GAAP company. Why is that assumption important? Yeah, now you know exactly what to do with interest. Actually, just to clarify, these numbers should just shift to the left one. So this cash paid for interest for 2010 is, so this number should be here. So does everybody find this easy, I hope? What is your starting point? This is your starting point, and then what did you do with this? So that's your starting point. You added back 18.97, so this plus 18.97 into 1 minus T And what else do you do? You subtract the purchases of property, plant and equipment, which is 55. Okay. So then you subtract 55 and the answer that you should get is about 118, which is what we saw earlier. Okay, what I told you to make, so the question is, why are we adding back interest? So I said that this is a US GAAP company. How does a US GAAP company account? So the interest paid gets shown in what part of the cash flow statement? It gets shown in the CFO. Now, what are we trying to find? We are trying to find the free cash flow to firm, which means the cash flow available to all providers of capital, which includes the bondholders. So the interest is available for them, so we add it back. So when you come up, so the question is, why don't we subtract taxes? Because is tax payment considered an operating expense? Yes. It is. Okay, so the CFO number that we come up with assumes obviously that taxes have already been paid. So it is, okay, so assuming that taxes have been paid. Okay, what do you do with non-cash charges? This is a relatively simple segment, just 3.3 in the curriculum. Historic non-cash charges should be closely analyzed to ensure that free cash flow estimates provide a reasonable basis for forecasting. You might have restructuring charges, which can be either cash or non-cash. For example, our severance pays, so money paid to employees that you have either fired or laid off, those are cash costs. There might be other restructuring charges such as asset write-downs, which are non-cash charges. Okay, you should carefully analyze deferred taxes. What does this mean? Remember from level 1 that there is this concept of deferred tax asset, which represents a future benefit. If the company is not expected to be profitable, then the deferred tax asset is not going to help you. Okay, deferred tax asset means that you will be paying less taxes in the future, but you only pay taxes if you are profitable. If you are forecasting that the company will not be profitable, then you need to discount the deferred tax asset. And I think from an exam perspective, the only thing you really need to focus on in this section is Exhibit 8, which just tells you something that you should already know, which is how to deal with various non-cash items. How do you deal with depreciation? In terms of you need to know how to adjust the net income. So these are the non-cash charges which impact not net income. So it is obvious, depreciation reduces net income, but since it's a non-cash charge, so you add it back. Amortization is like depreciation. Restructuring charges, which are expenses, are added back. Restructuring charges which involve some income or reversals, those are subtracted, and all the rest are just obvious. You just need to know that when you are looking at non-cash items, the point is that in our equation we simply see net income plus non-cash charges. What Exhibit 8 is doing is just blowing out those non-cash charges and telling you what to do with them. Otherwise, what do we generally assume? We only assume the only non-cash charge is depreciation. All this is pointing out that there are a bunch of other things that an analyst should also consider. I think the CFA Institute has hounded you enough with deferred taxes in level 1. So I've generally not seen them bother you with deferred taxes at level 2. But I don't think it's very likely to be tested, but nevertheless, I'll just give you a brief on what it was. Okay, so what is a deferred tax asset? A deferred tax asset is where you are expecting to pay less taxes in the future for some reason. Okay, so if you have a deferred tax asset of 10 million, that means that you are expecting your future taxes to be less by 10 million. So as an analyst, how will this impact your cash flow forecasts? You will be forecasting taxes. and then you will say, okay, this company has a deferred tax asset of 10, so then you will forecast lower taxes, right? But now you figure out that the company is not going to be very profitable. So if a company is not profitable, then it doesn't pay taxes. If it doesn't pay taxes, then does it help them that they have a deferred tax asset? No. Because a deferred tax asset simply reduces taxes. It doesn't mean that the government gives you money. It just means that it takes less money. So if you figure out that your target company is not going to have profits, then what will you do with deferred tax assets? You will just sort of ignore them. You will say they are useless. That's all. Okay. Now the next question, and you need to do, up till now everything I said, hopefully you either knew or have now, memorized. So just as a recap, you have figured out how to do free cash flow to firm from net income. Then we did free cash flow to firm from CFO. Now what we are doing is, once you've calculated free cash flow to firm, how do you calculate the free cash flow to equity? Okay. So what is free cash flow to equity? This is the cash flow available to equity holders. Okay. The way you calculate that is you start with the free cash flow to the firm, and then you subtract the interest expense. Why? Yeah, because we are taking, let's say we are equity holders, we want to see what money we have after we have paid the debt holders, the bond holders, plus net borrowing. If we are borrowing money, does that increase the cash flow that we have? It does. If later in our life cycle we are paying back principal, then this number will be negative. And obviously if you are forecasting your free cash flows to equity, then initially you might have positive numbers, long term you will have negative numbers. Ultimately it should obviously even out. If it will even out, then why are we worrying about this? Yeah, because of time value of money, right? So you need to know your cash flow for every year. Okay, so that was an obvious item. Okay, so just an illustration of how this will happen, and then I'll make you do some examples. So for 2010, we just calculated our free cash flow to the firm. To come up with free cash flow to equity, we subtract the interest. We subtract the interest paid. If we have net borrowing of this much, we add that, and we come up with our free cash flow to equity. I'm going to make you do some work on this. Okay, we'll do a couple more things to calculate, a few more formulas, and then get into an example. Okay, what if you need to find the free cash flow to firm and free cash flow to equity from either EBIT or EBITDA? There is a long explanation here, but ultimately what you need to know is the formulas that I'm going to highlight. I'll just for once show you the derivation, but don't be deriving this on the exam. Okay, on the exam you should have these totally memorized. These are things that when I took the exam I had these, the bottom lines written and memorized, so just have them pasted on the wall in front of you so that you know these well, because you are guaranteed to get questions on this. Okay, the top one, is it familiar? So we are figuring out free cash flow based on starting with net income. Is this familiar? So that's net income. All this is done from here to here is rewriting the net income. So if that is formula 1, this is 2. This 3 is just a rewrite of 2. And then what is 4? So 4 is EBIT into 1 minus. So does this look familiar? So basically you are taking the above formulas and coming up with this based on the above formulas. And then this is being rewritten. Free cash flow to firm is this. And free cash flow to firm is also this. I'm sure if you spend a couple of minutes on this, you will see the derivation. But at the end of the derivation, I want you to memorize two formulas. This one and this one. And I will give you a simple way to memorize this. Okay, let's start with So let's say that this is formula 6. Let me give you a way of memorizing 6. What are we doing? We are figuring out your free cash flow to firm starting with EBITDA. Everybody knows, I hope, what EBITDA is: earnings before interest, taxes, depreciation and amortization. What does free cash flow to firm represent? This is the total cash flow made to all suppliers of capital. EBITDA, so is this before taxes or after taxes? It is before taxes. So what do you think this underlined segment represents? EBITDA into 1 minus tax rate. So this means that you have taken your initial earnings before interest, taxes, depreciation, amortization and removed taxes. But you have removed too much tax here. Why? Because you did not take into account the depreciation tax shield. So then you add back the depreciation tax shield, that's why there is a positive. And then you want to subtract the fixed capital investment and working capital investment. Was the working capital investment and fixed capital investment, was this subtracted to come up with EBITDA? It was not. So to come up with your free cash flow, you want to subtract it. Okay, so anyway, that's how you can remember equation 6. And equation 5 is a simple derivation. Just remember that free cash flow to firm is EBIT into 1 minus tax rate. Plus you add back depreciation, which is a non-cash charge, and then minus this. So make sure you memorize these. And then, does this look familiar? We just did this. This is just saying, okay, once we have the free cash flow to firm from whatever method, we can come up with the free cash flow to equity. So there are a lot of little things, but they are relatively straightforward. Okay. So now, what I want you to do here, so this is example 7 from the curriculum. Okay, what I want you to do is come up with, so for 2007, we want to come up, actually I've sort of done this for you. So we want to come up with the free cash flow to firm starting with EBIT. I am expecting and hoping that you will learn this formula either right now or very fast. So free cash flow to firm, as we just discussed, is EBIT into 1 minus tax rate plus depreciation minus fixed capital investment minus working capital investment. Okay, so we are computing the free cash flow to firm. The key point here is this easy? Where did this EBIT into 1 minus tax rate come from? So where did the 500 come from? That's given as EBIT. 1 minus the tax rate is 40%. So that's easy. What is this 300? You are adding back depreciation, which is coming from where? So that's depreciation for the year. Do you add back accumulated depreciation or just the depreciation expense for 2007? Just the expense for 2007. Then minus 400, your fixed capital investment. So the gross increase in fixed assets, the gross amount went from 2200 to 2600. That change of 400 is here. And then where did the 45 come from? Yeah, but this is something that you need to be able to calculate. Okay, so here are the tricky parts. Your working capital for 2007, end of 2007, should it include the 200? No. Should it include this? This? Okay, what about, should we also think about the current liabilities? Should we include accounts payable? Should we include notes payable? Yeah, this is critical. Why do you not include notes payable? Yeah, it's interest bearing, it's considered financing. So even though it's might be under current assets, what about accrued expenses? So the simple way to deal with things like notes payable, anything on which you are paying interest, be it short term or long term, would not be considered part of working capital. So all these things that I have ticked, these are the items that you consider as part of your working capital. So at the end of the year, your working capital was 600 plus 440. That was your current assets. and the liabilities that are part of working capital are subtracted, the 300 and the 150. That's the payables and the accruals. So that's 590 at the end of 07, and similarly it's 545 at the start of 07. Okay, so the working capital investment is 45. So our free cash flow to firm is 155. And again, make sure you go, there are a ton of problems at the back of this reading. Make sure they are not all multiple choice, but they all require you to do these calculations. Do them and get comfortable doing them fast. Yeah. So right now we are doing, so the question is if there is a, yeah, so actually, essentially what we are doing is just the question is what do we do with gain on sale. Okay, actually we can, when there is a gain on sale, we need to make adjustments to the fixed capital investment, and there might be some adjustments here also, but I think the easiest thing to do with those is to do it in the context of a question. So we'll pick some question and make sure we address that. But
it's not really non-cash, so why?
What's that? One second. So the question is gain. The gain in of itself is not cash, right? So the easiest way to deal with that is we'll actually pick a question where that is covered. Otherwise, it's just very hard to talk about. So right now, let's just go with the flow in the curriculum. Okay, what I want you to do now is, so can you calculate the free cash flow to firm from EBITDA? So let's do it. Do you remember the formula? Okay. So I gave you a mechanism for remembering it. Let's see if that works. How many people can remember that formula? So here is the formula. So remember it was EBITDA, and this is as you are listening to this, you can just memorize. So starting with EBITDA, you subtract out the tax, and then why do you add back the whole depreciation tax shield? So the whole amount, because here you subtracted too much of a tax because you are not giving yourself the shield. So you add back depreciation into tax rate and then you subtract. So all these numbers are given. All these numbers are given and you come up with 155. Okay, now what have we done so far? We've come up with free cash flow to firm. How do we come up with free cash flow to equity? From free cash flow to firm. Do you remember the formula for that? What was the formula? So it was free cash flow to firm. Why are we subtracting this? Yeah, so this is the money available to equity holders. You need to pay off your interest expense after tax, and then net borrowing. So the tricky part here is what? Yeah, figuring out the net borrowing. Can anybody figure that out from what you see here? What do you think you'll look at? Will you look at the increase in long-term debt? So what's the increase in long-term debt? 25. Anything else you look at? Yeah, because we've already said that notes payable is also considered financing. Right? Since it's not operating, then it's obviously not investing, so it has to be financing. Notes payable. So what happened to notes payable? So it went up from 200 to 250. So that was an increase of 50. So your total net borrowing was 75. So the free cash flow to equity is your free cash flow to firm minus the interest after tax plus the 75. Say that again while calculating. So the question is, what do you do with the current portion of long-term debt? And the answer is all debt, be it long-term, short-term, very short-term, on which you are paying interest, is considered financing. So if you have short-term debt or current portion of long-term debt that's going up, then that is also included in your net borrowing. Okay, so very simple. Anything on which you pay interest. From an exam perspective, the reason I'm making you do these curriculum items is this is exactly the sort of terminology you'll see on the exam. So in general, notes payable is going to be considered part of financing. So increase in notes payable, increase in long-term debt, increase in debentures. So all that stuff will be financing. And just from the curriculum terminology, the two classic items which will be working capital liabilities will be accrued expenses and accounts payable. Everything other than those most likely will be financing.